Yes, we are.
Okay, hello everyone. Thanks for joining us. This is really cool. Thank you, Brian. This is really cool that we can have class when the university is closed. And the reason it's cool is so that we don't get behind, so we can still proceed at our regular pace, which is pretty good pace anyways. So what we're going to do today is we're going to try to have a normal class. I'm at home, and Brian's at his home. I'm sitting in my office, in case you're wondering, and behind me is a picture. So let's get started. So today we're starting Chapter 2. Just a little background on Chapter 2. Wi-Fi connection, perhaps. Brian, are you okay?
No.
Brian? How's
The
the audio
audio's
on your
a
end?
little bit weird. Like you
Okay.
stop talking for a couple seconds, and then you're good.
Okay. How is it now? I can also switch to the teleconference.
It's good at the moment.
Okay. Okay, we'll let it go. So anyways, so Chapter 2 is one of the most important conference chapters in the book. So what we're going to do is we're going to start with an example. And this is one of the ones that we have to solve for, so we should know how to do it by now. If liabilities are 500 and assets are 1,200, what's equity? Liabilities are 500, assets are 1,200, what's equity? What you need to do is you need to write down the accounting equation. Accounting equation is assets equal liabilities plus equity. Brian, why don't you put the number again, repaste it. Okay, let's go quiet for a minute. I'm going to switch over to the number myself. Hold on. Okay, so we're going to go quiet for a minute. Brian, why don't you, I tell you what, as I'm switching, Brian, why don't you, I'm going to put up the next question in a minute before I transfer audio. Yeah, we didn't do anything different in about 2 minutes. Okay. So just a minute, I'm going to put up, so this one is $700. I saw a lot of $700 going over through the window. So equity is 700, computations on the. So I'm putting up another problem. So while I'm switching audio, you can go ahead and work on this next example that's coming up. So I'm going to go silent for a minute or two, but work on this one.
Sounds good. So yeah, you all can read. Looks like the people on the chat went, so they got it. Yep. Coffee time. Serene, that's what calculators are for. I can't hear. So I think everyone needs to go and do the teleconferencing.
Okay, can everyone hear me? How's
Yes.
this one? How's that sound? Keeping up with it?
Yeah, it's good.
Okay, we'll do this for now and see how. Okay, let me turn that down. Okay, so in this example, I'm just going to continue. And Brian, I have to turn off my sound, so I'm not going to be able to hear you.
Okay, that's good.
So type to me in the window if you need to. You can talk to others. I just can't listen to you. Okay. Okay, so back to our example. If equity is 3,500 and total and assets are 57, how much is total debt? The answer, if we use our assets equal liabilities plus equity, we are going to have 5,700 in assets equal to liabilities plus 3,500 in equity. So we rearrange that and we end up with liabilities of 2,200. Now, something to note as we wait for the screen to catch up here. Liabilities equals debt. So in the question, I was talking about debt, but debt is synonymous with liabilities. And so I think I've waited long enough on that one. So next we're going to have a question. Okay, so any event that has a financial impact on the business and can be measured reliability is what? An expense, a transaction, an asset, or a journal? You know what, today let's not do the poll. Brian, I'm going to change the rules on you right now. Let's not do the poll right now. Go ahead and type in the chat window for today only, or you'll drive Brian crazy in the future. But this way I can kind of see what people are answering since I can't see anyone in front of me. Oh, I guess I can see in the poll window, can I? Brian's probably saying, look in front of you. Okay, so in this one, the answer is the popular answer of B, transaction. Okay. Yes, it is B, transaction. A transaction has a financial impact and it can be measured. When we talk about transactions, because this chapter is all about transactions and recording them, we talk about every transaction having two sides. There is usually something that we give up and something that we receive. There are two sides to every single transaction, and we're going to record both sides. Okay? So every transaction has two sides to it. We have to record both. This is called double entry accounting. So speaking of transactions, we have a question then looking at which one of the following events would not be recorded in a company's accounting records. So what we're looking for is what would not be a transaction. So we have the first choice, the company paid a monthly utility bill. The second choice, the company issued 100 shares of common stock. C, the company purchased 2 acres of land for future plant expansion. Or D, the company signed a contract to provide services in the next accounting period. Okay, so a lot of those answers go by online, and it is indeed D. Now let's talk about why all of these other answers are not right. The company paid a monthly utility bill. What we've got there is we've got utilities, expense, and cash that we paid. For B, the company issued 100 shares of common stock. They're getting cash and issuing equity. C, if we purchase 2 acres of land, we're giving up cash and getting land. But in D, nothing has actually occurred here other than we signed a contract. So we haven't given anything up. We haven't gotten anything yet. That's a future thing. So D is the answer here. Okay, now what we're going to be doing is looking at some common accounts. Transactions are recorded in accounts. So we have 3 main types of accounts. We have assets, liabilities, and equity. And then within equity, we have different types of accounts. But when we talk about assets, these are typical assets that you're seeing on the screen here. We've got cash. Cash is always the first thing listed on a balance sheet, by the way. Assets appear on the balance sheet. We have accounts receivable, which are amounts due from our customers to us. It's like IOUs from our customers. We have notes receivable, which are signed promissory notes. We've loaned cash and we have a signed note for them. We have prepaid expenses. Prepaid expenses are when we pay for a year in advance of something or 3 months in advance. If we buy office supplies for the next 6 months, that's prepaid expenses. If we pay our insurance for the next year, that's a prepaid expense, which is an asset. We have inventory that we're holding for sale. We have land. We have buildings, equipment, furniture and fixtures, other assets. So we have a variety of things that can be assets. This is a good sample list of some assets that we might see. Okay, so those are some assets that we'll use when we talk about how to record transactions. These are some of the assets from which we have to choose. So then we could leave assets and we go on to liabilities. And some typical liabilities are going to be accounts payable. Accounts payable is typically listed first. It's what we owe for things that we bought in the normal course of business. If we go to OfficeMax and sign a purchase order or sign an invoice that says we'll pay you in 30 days, that's accounts payable. Salaries payable at the end of the year. If we're not going to be paying payroll for a few days after the end of the year, but it relates to a prior year, that's salaries payable. Accrued liabilities are liabilities we owe but have not yet paid. Short-term notes payable, we signed a note typically with a bank. Okay. Current portion of long-term debt, that's how much we're going to have to pay in the next year. Mortgage payable, that's what it sounds like. We owe a mortgage loan. And long-term notes payable, we signed a note with the bank and it's due in more than 12 months. The distinction between short-term and long-term here is 12 months. If something's due in less than 12 months, it's short-term. If we're going to pay it in more than 12 months, it's long-term when we're talking about liabilities. A lot of liabilities have the word payable in them, which is kind of nice. Or they refer to debt or liabilities. On that sheet for your exam, I would know I would definitely look at putting down typical assets, typical liabilities, and then we're going to have equity coming up here in a minute too. So be able to distinguish what kind of account things are. Okay. So we have assets we went over, we have liabilities. Next, we do equity. So you notice we always go in the same order as the accounting equation, assets equal liabilities plus equity. We're just reinforcing that here. So equity. There's two main types of account in equity. There's more than that. But common stock and retained earnings are the two main types of equity. We also have a bunch of other stock accounts, but for right now, common stock is good enough. And retained earnings. Retained earnings is our accumulated earnings to date Retained earnings are accumulated net income to date less any dividends we've paid. Okay, so right below retained earnings there, I have the three kinds of sub-equity accounts. Revenues are a type of equity accounts. They increase retained earnings, and that's why I have a plus after them. Expenses are a type of equity account, and they reduce retained earnings. And dividends are also a type of equity account, and they reduce retained earnings as well. Okay, so revenues minus expenses is net income. Remember that dividends never impacts net income, but dividends do reduce retained earnings. These three types of accounts that I just went through, assets, liabilities, and equity, are all good things to put on the sheet for the exam, and you'll be using these kind of things as we go forward throughout the rest of the course, actually. Okay, so now we're going to do a couple questions relating to the different types of accounts. And the first question, just coming up here, which of the following is a liability account? Okay, A, retained earnings, B, accrued liabilities, C, accounts receivable, D, prepaid expenses. Okay, so yeah, as predominantly the answer here is indeed B, the popular answer, and we can go back to using the poll feature now because I put the window up so I can see it now too. Okay, so accrued liabilities is a liability. The word liabilities in there helps us. Retained earnings is an equity account. Accounts receivable is an asset. Prepaid expenses is an asset. So those are the types of accounts there. Next, we have I have a couple questions here about what type of accounts things are. And again, we're going to use the poll feature now, not the window. Goods purchased on account for future use in the business, such as store supplies, are called A, accrued liabilities, B, expenses, C, revenue, or D, prepaid expenses. Okay, I'm going to address your question in just a minute, Rhonda. I want to answer this question, and we'll talk about accounts payable. Okay. Okay, anyone else want to answer in the full feature in the window? Pull. Okay, so in this particular one, we have 31 for D, we have 4 A's, 4 B's, and 2 C's. The answer is indeed prepaid expenses. Okay, now goods, the actual goods purchased on account for future use in the business, such as store supplies, so perhaps we're buying bags or things that we use for packaging. When we purchase these goods, those are considered prepaid expenses. They're an asset because they have future economic value to us. So those are classified as assets. As we use them up, they turn into expenses. Now the other side of this transaction, and I think this is what Rhonda, you were asking about, the other side of this transaction, how we pay for it, is accounts payable. But this is asking about the actual goods purchased on account. So remember that every transaction has two sides. This was asking about the side relating to what we actually purchased. So we purchased these goods on account. Those are an asset called prepaid expenses. They have future economic value to us. The other side of this transaction would be accounts payable if we didn't pay cash. So that would be the other side, but here we're actually referring to what we purchased. So that's the difference there. We have another question relating to what type of account something is. All of the following accounts would be considered assets except for A, cash, B, retained earnings, C, prepaid expenses, or D, notes receivable. Okay, I'm seeing in the poll window we have a lot of responses, and this one we have 33 right now B's, and B is the right answer. And let's go through these. Cash is an asset. That's the very first asset we're going to see on our balance sheet always. Prepaid expenses are assets. These are when we, for example, we buy supplies, and those supplies we're going to use over the next 6 months. They have future economic value, so those are assets as well. Notes receivable, we're due money. We've loaned money out. Somebody owes us. That's also an asset. So the answer here is retained earnings. Retained earnings is considered equity. Remember that retained earnings is a running total of all our income to date less any dividends we've paid. Okay, next we're going to go on with some homework. Okay. So the homework problem we're going to do is short exercise 2-2. Now, this homework problem, we are told, I like to read these and see what we're looking for. First of all, we're looking for how much in total assets does the company have, how much in total liabilities do they owe. So the first thing so we have to pick through what went on here. So the first thing I do is I just start with the first sentence. The first sentence, it said it began with cash of $11,000. Okay, so that's not a transaction. That's simply telling us a beginning balance. Okay, so we started with cash of $11,000. Okay, so that is the cash beginning balance. Then that next part that I've circled in purple, bought supplies for $2,400 on account. So let's analyze what went on there. Supplies is an asset. Liability on account is a liability. That's accounts payable. So what went on in the circled portion there? Bought supplies for $2,400 on account. Remember, every transaction has two sides. In this case, supplies increased. Supplies, an asset, went up. Liabilities, which accounts payable, went up as well. Now, I do want to talk about that. Whenever you see the words on account is going to tell you this is one of two accounts. You have two choices and two choices only. It's either going to be accounts receivable or accounts payable. Accounts receivable means that somebody owes this company money. Accounts payable means that this company owes the money. In this case, Smith bought supplies for $2,400 on account. So if they're buying supplies on account, that means they owe for the supplies, and that's a liability. So again, just circling back to what we've done so far, we began with cash of $11,000. That means that's the beginning cash balance. Okay, so that's not a transaction. That's just telling us that that is our beginning cash. Now, the purple part, the bought supplies for $2,400 account, that is a transaction. It has two sides to it. We have an asset. We're getting an asset. Assets increasing, and then we owe money, and that's accounts payable, and that's increasing. Okay, now we have one more sentence in this problem, and it says, separately, Smith paid $5,500 for a computer. So $5,500 for a computer, there's another transaction, okay? Now, this transaction, the $5,500 for a computer, we paid $5,500. If it says we paid $5,500, that means we paid cash. That's the implication there. So cash went down, cash is an asset, and in return, we got an asset, a computer. Okay, so asset went up. So in this transaction, we gave up cash and we got a computer. Okay, so in this particular problem, we have a beginning balance of cash, the part that I circled in red. Then we had a transaction where we bought supplies for $2,400 on account, which increased our assets by $2,400, increased liabilities by $2,400. And then we had this last transaction, which we decreased assets by $5,500 and increased assets by $5,500. See that last transaction? The net impact on assets is nothing. We paid out $5,500 cash, so that made assets go down, but we got a computer, so that made assets go up. So when this first question then, so now that we've done all that, we can answer the question of how much in total assets does Smith have? Well, how much in total assets does Smith have? We're going to start with the beginning balance of $11,000. So they began with beginning balance cash of $11,000. Then in that second transaction that we had circled, we had supplies that we bought for $2,400. So supplies and asset went up by $2,400. So now I'm referring back to where we had assets going up or down. Then we had $5,500 in a computer that assets went up for, but we paid cash for that computer, so it went down by $5,500 as well. Assets went down. So when we say how much in total assets does the company have, we would take the beginning balance of $11,000 plus the supplies we bought of $2,400, plus the computer we bought of $5,500, minus the cash we paid for the computer, and we get $13,400. That is the answer for part A. How much in total assets does Smith have? Again, when Smith paid $5,500 for a computer, there's two things going on there. Both things impact assets. He got a computer for $5,500, but he paid $5,500, so assets also went down with that cash. Whenever it says we paid for something, the implication is that we paid cash for it. Unless it says on account or something else to make it obvious that it's not cash, we assume it's cash. So the answer for A is $13,400. So then B, how much in liabilities does Smith owe? Well, there was only one liability in that when we went through each of those accounts. And the liability is when we bought supplies for $2,400 on account. We increased liabilities by $2,400. There were no other liabilities that we talked about in this problem. So the answer for B is going to be $2,400. So that's a real neat little, quick little problem. The big stumbling block on that one is to remember to pull out the cash that you paid for the computer. That's what I see happen the most in this exercise, is people forget to add and subtract the $5,500. Okay, now we're going to go to a question. Okay, this question, when services are performed on account. Okay, so this is a good one. We haven't directly addressed this one, but when services are performed on account, what happens? A, is cash increased? B, and we're going to use the poll window for this too, the polling feature for this. B, revenue will not be recorded until the cash is received from the customer. C, accounts receivables increased. D, accounts payables increased. Okay. Now when it says when services are performed on account, we are talking about from the company who's performing the services standpoint. So let's say this is Davey Tree. When Davey Tree provides tree services, tree trimming services on account, what happens to Davey Tree's books, basically? What happens from their transaction side? So when services are performed on account. I'm going to give it just another minute or so, and then we'll talk about this one. Okay, the overwhelming answer, we have 24 C's, but we have some D's and some B's, so we're going to talk about those. Okay, when services are performed on account, the answer is accounts receivable is increased. So what's happening here, let's use Davey Tree as our example. So Davey Tree performs tree trimming services on account. That means their customer owes them money. Davey Tree does not owe money. So Davey Tree has an accounts receivable now. Accounts receivable are amounts due from customers, amounts due to the company from customers. So when we perform services on account, we're getting revenue and we're setting up an accounts receivable. Now, when services are purchased on account, that would be accounts payable. So we have to think about the company that we're recording for. Are they owing the money or are they due the money? So accounts receivable is when the company is due the money from its customers. Accounts payable would be when the company owes the money to someone else. Revenue is recorded when the services are performed, not when the cash is received necessarily. Okay, so that's why B is not right. So services performed on account, accounts receivable is increased. Okay, we have another transaction question here. This next transaction, we're recording it from the standpoint of the company that received cash in exchange for issuing stock. So a company received cash in exchange for issuing stock. This transaction increased assets, and what is the other side of this transaction is what it's asking. So for the company that's receiving cash in exchange for issuing stock, its assets would have gone up, and what else happened here? So use the polling feature. Okay, we have 29 Ds, which is great. We have a couple Bs and a couple Cs. So the answer is going to be increased equity. So what happens if we receive cash in exchange for issuing stock? We get cash, which increases assets. This also increases common stock, which is an equity account. So we're issuing stock, we're increasing equity, so the answer is increased equity. And I think that was an overwhelmingly popular answer there. Another transaction question coming up. When a business purchases land on account. So what happens when a business purchases land on account? A, are both assets and stockholders' equity increased? B, assets are decreased and stockholders' equity is increased? C, both assets and liabilities are increased? D, assets are increased and liabilities are decreased. Okay, so business purchases land on account. So when we purchase land, assets are going to increase. So we know we have to increase assets. And then we're on account means we're increasing liabilities as well. Accounts payables going up. So the answer in this case, we had 37 people answer C, and that is the answer. Because we are increasing assets, we're getting more land, and we also are incurring more debt, so liabilities are increasing as well. Okay, next we're going to go on to a homework problem. Okay, this is another neat little problem. It illustrates a lot of different concepts. So short exercise 2-3, we have someone opening a medical practice. the business completed the following transactions. So it gives us a list of transactions. Okay, so our list of transactions there. So we're going to look at the last question. After these transactions, how much cash does the business have to work with? Use a T account. So we're going to look at some different, a T account coming up here now. So what we're going to do is, the first thing we're going to do is look at each of these transactions and figure out what impact this has on cash. And the reason we're doing that is because the question says, after these transactions, how much cash does the business have to work with? So we're interested in cash. So everything we're looking at, we're not looking at both sides. We're looking at impact on cash only. So April 1st, Veritech invested $27,000 cash to start her medical practice. The business issued common stock to Veritech. Okay, now the transactions are all done from the standpoint of the business, so the medical practice. What's happening to cash at the medical practice? We're not doing the transactions for the individual, we're doing the medical practice, transactions. So the medical practice received $27,000 of cash. So that means the medical practice's cash went up by $27,000. Okay? So cash would increase by $27,000. We're going to do a T account at the end, but for right now, what I'm doing is I'm going through each transaction and putting whether it increased cash or decreased cash. So this first transaction, cash increased by $27,000. And again, we're recording this from the standpoint of the business. Okay, next transaction down. The next transaction down says that we purchased medical supplies on account totaling $8,800. So remember, this exercise, we're looking for the impact on cash. This particular transaction had no impact on cash whatsoever. We purchased medical supplies on account. So we got medical supplies, and we said, we'll pay you later. That's accounts payable. There is no impact on cash. Later on, when we pay for it, it will, but not right now. April 1st, that transaction does not impact cash, so we don't have anything to record. Okay, next, April 2nd, paid monthly office rent of $3,500. We paid it, so we had to have paid with cash. We paid monthly office rent of $3,500, so what that did is that decreased cash by $3,500. Now, when I say cash, we can also be talking about checks or our checking account, our savings account, but basically cash. It doesn't have to be just currency. But April 2nd, we paid monthly office rent of $3,500. So far, we have April 1st, the business got $27,000 of cash. April 2nd, the business paid $3,500 of cash. And then April 3rd. Now, April 3rd says that we recorded revenue for service rendered to patients. We received cash of $2,200 and sent bills to patients for the remainder. Okay, so April 3rd, remember all we're doing here is we are going through searching for the impact on cash. And in that particular transaction, the impact The impact on cash was $2,200. So we can ignore everything else in that transaction because in this exercise, we're not recording both sides of the transaction. All we're doing is looking for our impact on cash of each of these transactions. So now what we've got on the screen at the top, April 1st, we increased cash by $27,000. April 2nd, we decreased cash by $3,500. And April 3rd, we increased cash of $2,200. And again, we're doing this from the standpoint of the business. So now, keeping those numbers in mind, we have a T account. Now the T account is at the bottom of the screen. The T account is simply a T. So if we look at the T, I've drawn the second line, but ignore the second line for the moment. But we've drawn this T, we write the name of the account. And it's a way for us to keep track of what's going on. The first thing there, this is cash, so every increase to cash would be on the left side, and every decrease would be on the right side. And we're going to talk about this more on Thursday and next week, the week after as well. So every increase goes on the left side. So we have $27,000, that was April 1st. We have $3,500 decrease, that was from April 2nd. That $3,500 was a decrease. And then April 3rd, we had an increase of $2,200. So right there are our three transactions impacting cash. So what we do then is we draw that underline all the way across under the $2,200, all the way across. So how we get a balance of the account then is we add up the things on the left side, subtract the things on the right. So we would add the $27,000 plus the $2,200, and then we would subtract the $3,500 that's on the other side. And what we get is $25,700. It goes on the left side because the left side is larger. So depending on which side's larger, that's where the balance will go. So all this is doing is saying our balance of cash is $25,700. We could have done the same thing without a T account. We could have said, boy, we started April 1st with the $27,000 increase. We deduct on April 2nd the monthly office rent of $3,500, and then we add on April 3rd the $2,200 we received, and we would end up with that balance of $25,700. A T account is simply a way to keep score, in effect, is what we're doing there. And we are going to see a lot more T accounts in the future, but this is the most basic one. This is probably the simplest one. It is cash. And next, we're going to go on to another homework problem. Chapter 2 is one of the most fundamental chapters we're going to see in here. And so this one, there's a fair amount of homework, but they go pretty quickly. But it is, you've got to get this chapter. This chapter is so important to the rest of the whole entire rest of the semester. Okay, so now we're going to go on to exercise 2-5. Now, exercise 2-5 is exercise 2-5. We're not going to, yeah, I guess we could use the polling window. Brian, do you want to change the polling choices to A through E, 5 choices here? Okay, now when you do this homework problem yourself, your examples will be slightly different than mine, and my purpose here is to kind of show you how to think through this one. Okay, so what we're going to do here is it says we have a company completed a series of transactions, and it tells us for each of these items, give an example of a transaction that could create this effect. So we're not saying this is the exact answer in your homework, but these are some examples. So what I'm going to do, how we're going to do this, is I'm going to put up a transaction, and then we'll say A, B, C, D, or E, how that transaction, what that transaction is an example of. So we'll start with the first one. Okay, so the first one I have, appearing on your screen soon, is I have paid dividends to owners. Okay, so paid dividends to owners. So the idea here is to say, okay, what's that an example of? So let's reason through what's happening here. If we pay dividends to owners, dividends are cash, okay? So cash is an asset, okay? So what I do with this is I pick one side to start with, and I'm usually picking cash because it's the easiest one. So I paid dividends to owners, I pay out cash. So cash is decreasing because I'm paying it out. Cash is an asset. So I'm going to be decreasing an asset. So I know right now this answer has to be B or C, right? Okay? And then the other side of this is I paid dividends. So I have that account dividends. And think about what type of account dividends is. Dividends is an equity account. Dividends decrease equity. So what we've got here is the answer on this one is I'm going to be B, decreasing an asset, and decreasing owner's equity. Okay, and the reason that is the way it is we paid out cash, so cash would decrease, and we also had dividends. We paid dividends, and dividends reduce owner's equity. Back at the very beginning of class today, we had the three types of accounts. We had assets, liabilities, and equity. And equity, the equity slide, when I went through that, we had revenues increased equity, expenses decreased equity, and dividends decrease equity as well. So that's why that is. So now we're going to try the next one. So the next one, so paying dividends to owners is an example of decreasing an asset and decreasing owner's equity. So now, my next example, and this one you can put the answer in the poll window for this next one that's coming up. The next one that's going to appear in a minute, purchased office supplies on account. So figure out which one of those that would be an example of. Wow, very good. I'm seeing lots of correct answers there. Lots. Okay, so let's kind of reason through here. We purchased office supplies, so every transaction is going to have two sides. So we purchased office supplies. So office supplies are an asset, and if we purchase them, we're increasing assets. Okay, so we know we have to increase an asset with this. And when we purchase them on account, that means we owe them. Now, right now, I've got 32 people said E, and that's absolutely right. We have a few A's and B's. And so when we purchase something on account, that's accounts payable, and we're increasing a liability. So what happened here is we increased office supplies, which is an asset, and we increased our liabilities because now we owe something that we did not owe before, so that increases the liability. Okay, next transaction. Next transaction, we issued stock for cash is what's coming up. Again, when you do this homework problem, your examples are going to be different, and you just kind of have to reason through them. Know that if you guess and it's not right, go ahead and finish the exercise, and then you can try again. So next one, issued stock for cash. So decide which one of those that's an example of. Okay, this is really interesting as I'm seeing people vote on this one. Okay, so we issued stock for cash. Let's zero in on the cash side of that. What's happening to cash? So cash here is increasing, right? Because we're issuing stock, we're giving out stock, and stockholders are giving us cash. So cash is going up, that's increasing in asset. Okay, so we know absolutely positively the answer has to be A, D, or E. So we can narrow down, we know it's not B or C. So we're increasing an asset, right? So we're increasing cash. Now what's the other side of this transaction? The other side of this transaction is we issued stock. So we're going to say what kind of account is stock? When we think about stock, we can say stock or common stock. Common stock is an equity account, okay? So we issued stock. So now we have equity that we never had before. We're getting cash and we're increasing equity. So the answer here is going to be D, which was overwhelmingly the popular answer. 35 of you said D, and there were a few A, B's, and E's. So the answer is increase in asset, which is cash, and increase owner's equity, which is the common stock. Okay, our next one, we purchased a building for cash. Purchased a building for cash. The thing that I like to do when I do these is think about the impact on cash first, because you know cash is an asset. So I'll wait to get a few more answers in the chat room. Okay, so we purchased a building for cash. So let's think about what happens to cash. So we purchase a building for cash, and I don't know if this is, I'm going to clear this out again. Let me just have you try again, because we had a lot of incorrect answers there. So on this one, we purchased a building for cash. We are purchasing the building. So we are getting a building. So a building is an asset, and we are paying cash. So this is an example where we're increasing our building is an asset, and we're decreasing cash, which is also an asset. So this is an example of increasing one asset, which is the building, and decreasing another asset, which is cash. So there, yeah, okay, so we have unanimous correct answers now, so that's great. Okay, so our next one, we have another example. Again, in the homework, you're going to get different examples. You might actually have to make your own examples, but these are just ideas for you of how you go through and analyze that. Okay, this last one. Pay amount owed to OfficeMax for invoice from last month. So pay the amount owed to OfficeMax for invoice from last month. What's that an example of? Wow, just about everyone has the right answer. This is wonderful. This is, we pay amount. So we have cash decreasing, so we know it has to be B or C. We have to decrease an asset. And for the invoice from last month, so we're reducing a liability. We're reducing accounts payable is actually what's happening here. So we're reducing cash and reducing accounts payable. So that's decreasing an asset and decreasing a liability. Okay, so now we have a couple of questions, and then we have one more homework problem, and we're done for today. So, our question, so more transactions. Which of the following transactions will increase one asset and decrease another asset? A, the purchase of office supplies on account. B, the performance of services on account. C, the purchase of equipment for cash. Or D, performance of services for cash. Wow, once again, overwhelmingly the correct answer is being selected, so this is wonderful. Okay, which of the following transactions will increase one asset and decrease another asset? It is indeed C, the purchase of equipment for cash. So equipment is increasing, that's an asset, and cash is decreasing, that's also an asset. So the answer there is indeed C. Okay, we have another question coming up. Okay. A company paid cash for an amount owed to a creditor. This transaction decreased cash and what? What else did it do? Did it A, decrease revenues, B, decrease liabilities, C, decrease expenses, or D, increase expenses? Wow, once again, almost unanimous answer B. It decreased liabilities. And this is, again, reinforcing. We pay cash for an amount owed to a creditor. So what's happening here is we're reducing cash, but we're also reducing our liability accounts payable. So it decreased cash and decreased liabilities at the same time. Every transaction has two sides. Okay. So next, next we're going to do a homework problem, and there's no computations in this one. We're simply talking about a list of transactions. So we have it's exercise 2-15A, and these transactions were experienced by the corporation or a major shareholder. Now, the idea here is to state whether each event either increased, decreased, or had no effect on the total assets of the business. Identify any specific asset affected. Okay, so what we're doing, that's important there to remember that we're looking at the impact on the total assets of the business. So we're not looking at the liabilities or the equity, and so we're looking at total assets. And the other thing to note, the business, not the individual, not the major stockholder. We're saying we're looking at this from the business standpoint. So the first one has, we received $8,500 cash from customers on account. So what impact does that have on total assets? So we have to basically say what went on in A. Well, what went on in A is we received cash, so cash and asset went up, but we received it from customers on account. On account from customers is accounts receivable, which is also an asset. So we increased cash, we decreased accounts receivable, so the impact of A is no effect. Okay, so you see what we're doing. We're doing this from the business standpoint, the impact on total assets. And the two assets affected there would be cash increase, accounts receivable decrease, so there's no overall effect on total assets. Okay, item B, Flip, the stockholder, used personal funds to purchase a flat screen TV for its home. The question is, what is the impact on total assets of the business? There is no effect of total assets of the business. That's a personal transaction. It has no bearing on the business whatsoever. Okay, now entry C. Entry C, we sold land and received cash of $71,000. The land was carried on the company books at $71,000. Okay, so we ask ourselves, what accounts are affected here? Well, land, we sold land. So land went down, okay? Land is an asset. And what did we get for the land? We got cash, which is an asset. So the impact there is no effect on total assets because we have land going down and cash going up, exactly the same amount, so they are completely offsetting, so there is no effect. Entry D, we borrowed $56,000 from the bank. Okay, we borrowed $56,000 from the bank. So what's going on here? Well, we borrowed $56,000. That means we're getting cash. We go to the bank, we sign papers, they give us cash of $56,000. So cash is going up. The other side of that is going to be loans payable or notes payable, which is a liability. So for D, assets, total assets of the business increased because cash went up. Entry E now. We made a cash purchase of land for a building site. Okay, so we made cash purchase. So that means cash went down. And what did we get? We got land. Land is also an asset. So that, again, has no effect because cash decreased. Cash is an asset, decreased. Land is an asset, and it increased. So there is no effect. Our next transaction, we received cash and issued stock to a stockholder. Well, when we receive cash, cash goes up. We issue stock to a stockholder. That's equity. That's common stock, which is an equity account. So overall, our assets went up because cash increased. Entry G, we paid $68,000 cash on accounts payable. When we pay $68,000 cash on accounts payable, what's happening there is we're paying out cash. So cash is an asset and it's going down. Accounts payable is a liability, so it doesn't affect total assets. So overall, our assets decreased in entry G because cash went down. Okay, entry H, we purchased equipment and signed a $104,000 promissory note in payment. So we purchased equipment. Equipment is an asset, so it increased. And we signed a promissory note in payment, so that's notes payable, that's a liability. So what happened here is overall assets increased because the equipment went up. The other side of this transaction is a liability. Now, I purchased merchandise inventory on account for $16,500. So what is happening here? We're getting merchandise inventory, so that's an asset. So we know assets are increasing. And when we purchase them on account, that means we owe the money now. That's accounts payable. So liabilities would be increasing. So what's happening here is inventories increasing, which is an asset. Liabilities are increasing. So the net effect on assets is they increased. And finally, J, the business paid Flip a cash dividend of $7,000. Okay, so we have to really be careful on this one. First of all, we're recording this from a business standpoint. So what happened with the business? The business paid a cash dividend. So that means cash went down. So cash would have decreased. And then dividend is the other side of this. This is equity. It would have reduced equity as well. So overall, total assets would have gone down. Okay. Again, on these homework problems, any of the homework problems we tried today, that we did today, go ahead and try them. And if you don't get it right, at the end, when you finish the exercise, there'll be a similar exercise button, and you can try it again. So let's see what we have next. Okay, so I thank you for coming today. And we went over some of the questions that will be in the attendance quiz for this week. And we went over some of the homework problems. And then on Thursday, when we're back in the physical classroom or you're online, whichever way you prefer, we'll be finishing up Chapter 2. So what's due this week, we have the attendance quiz 6 and Chapter 2 homework. Remember, attendance quiz 6 will show up before 5 o'clock or before on Thursday. And then video quiz 7, just want to mention that video quiz that's due Sunday, we are covering Chapter 4 next week. So know that we are going out of order. We're doing chapters 1 and 2, 1 day on Chapter 4, and then we'll have 3 days for Chapter 3. So we're finishing Chapter 2 this week, and next week we're going into Chapter 4. So any questions before we go? Yeah, and so I will go back to that slide in a minute. Brian, why don't you go ahead and stop recording?